Hi, I'm James Brookes, and welcome to From the Factory Floor, a conversational podcast about all things startup and tech, brought to you by the folks at Thestartupfactory.tech.
And welcome back to another episode of From the Factory Floor. As ever, I'm your host, James, and I think now fairly regular is my co-host, Nairi.
Oh,
how are you
good
doing?
Promoted. Hi, are you okay?
I think so. Yeah, not too bad. How are you?
Yeah, good, thank you. Trying to keep warm.
Yeah, it's that stage of December where I think heat is probably the most paramount thing. Although not to founders and startups who, as ever, and are usually after some investment, which is why we're very gladly joined today by Chris Earle. Chris, how are you doing?
Hi, James. Yes, I'm good, thank you. Yeah, thanks for having me on.
Hi, Chris.
Thank you
How
for
are
joining
you?
us.
Hi, Nari. I'm good, thank you.
So, what we really want to talk about today, Chris, is about how you got into investing, especially as you do at very early stages, your experience of it, and some advice for people who might be either thinking about getting investment or getting into investment potentially. So, I guess first and foremost, if I sort of hand the mic over to you and do a sort of brief intro into you and what it is you do.
Yeah, sure, no problem. I've been involved in active investments for probably about 3 years now. Up until late 2020, I was chief exec of a company called Veristar, which is a multi-utility provider to SMEs in the UK, and it was private equity owned. And I think the being involved with small businesses and understanding the private equity side of things made me see how things can work if you get it right, and also understand how things can go wrong as well. So I think that's probably when I quit working full time why I decided to go down the routes in which I did. And what I do now, really, well, there's two things I do really. So the first one is I'm a active investor in startups, so an active angel, if we want to use that phrase. And then the second thing I do is I'm a non-exec director in a larger company as well. So it gives me a good spectrum of knowledge from the very early phase of businesses. Then I'm invested in a business which is a bit bigger. So that's kind of on the scale up journey. And then the business that I'm a non-exec investor in is further along that scale up journey, although I wouldn't call it mature yet. It's still got a lot of growth potential, which it seems to be going quite well at this moment in time.
Nice. So, obviously, what was it that really enticed you about one, especially the early stage aspect? Because now you can probably speak to this as well. When we've worked with startups in the past, a lot of people have been really focused on that scale up aspect rather than necessarily the startup aspect, which I know obviously with some of the ventures you've joined us on, is kind of where you've focused as well.
Well, I wanted to be involved in the businesses that I invested in, and to be involved at a very early stage, it means you can help steer it a little bit better. Once it's established and it's in that scale up phase, you have less of an impact. And for me personally, I wanted to be actively involved in the businesses I invested in rather than just putting some funds in. So that was one of the reasons. And secondly, is a question of money. You get a bigger slice of the ownership the earlier you get in, because it's worth. It's not worth as much. I was going to say it's worth less than, but it sounds bad. It's not worth as much. So you get a bigger share of the action, but obviously you're taking far greater risk as well. Many businesses will fail in that early period, and helping them get through those first few years is a big win if they get that far.
Yeah. But I think you're mitigating the risk as well, aren't you, by bringing your own expertise in to that. And there's huge added value to the founder to bring somebody in with your sort of expertise early on, rather than, like you say, just writing a check. And I suppose just for clarity, we should say, Chris, you have invested in a couple of the TSF early stage startups at quite an early stage, very different. And I wondered, like, if you could just tell us a little bit about what you looked for in those businesses. Obviously, you're still looking for a degree of potential, or potential traction is more limited at that stage. So could you just give us an indication of kind of what helped you make your decision, I suppose?
Yeah, I think there's a few different things. I think the biggest thing of all is you've got to understand the business. So they need to kind of understand what they're trying to achieve. And coming from a background of recurring services business, I tend to focus on investments that have a recurring revenue model to them. There's lots of other good ideas and good investments, etc., which I could look at, but I don't understand them as well as recurring revenue. So I look to go with something which I understand, and therefore it's really important for the founder of a business to be able to articulate very clearly and concisely what that business is going to do. And you don't need loads of detail at this stage. You just need to convey this is what the product is going to be, or the service is going to be. These are the target customers, and this is how it works. Preferably in about 30 seconds, because then it starts getting too complicated after that. So that's probably the first thing for me. The second thing, like I said, is it being something which I feel that I can add value to. So be it recurring revenue or something else, but something where I feel that my experience is going to be relevant. I don't really want to be an investor that just puts money in and then almost becomes an overhead to the founder by asking questions which are not helpful all the time. I want to be able to give advice which might speed things along, aid the decision making process, and avoid mistakes, and hopefully take advantage of opportunities as they arrive. The third thing which is important to me is starting to get a little bit of an understanding of the financial model. So particularly the unit economics of what is being produced or what is being delivered, understanding what the cost of acquisition for customers is likely to be, and sanity checking the assumptions from the founder in that model, and also what the revenue, the margin, if it's a recurring revenue model, how long we anticipate the customers staying around for, because those things can vary massively from model to model. But that's a key fundamental which is clearly unproven at a founder stage, but you have to be able to believe the assumptions that drive those numbers and challenge those assumptions, and get the founders to challenge them themselves, because there is quite often a lack of knowledge, a leap of faith. There's a lack of information that makes those numbers accurate, but you have to provide as good an estimate as possible. I think this is one of the areas where I feel I can help, because having been involved across 8 different industries in my previous role, you get to understand the differences in markets, but all the similarities in markets. And if I can help narrow down the range of estimation within those models, it A, can encourage me as an investor, and B, hopefully make sure the founder's making decisions which ultimately are going to make sense in the long run.
Yeah, because I think when it comes to numbers, it's interesting when we get decks, and often sort of people ask for advice on the sort of numbers they need to be looking at. It's that balance between what's a reasonable number to tell in the story versus wanting to show some optimism and a bit of drive, versus them wanting to not seem like they're being so overly ambitious that they're ridiculous. I think that's often the sort of trying to thread the needle aspect that, especially when it comes to financial predictions, that a lot of founders I think tend to struggle with.
Yeah, I think as a founder, you've got to be A, confident that you're going to deliver some good numbers, and B, investors kind of want to see that there's a big opportunity. So you've got to show them enthusiasm and what good could look like. And then also, most investors are kind of aware that people are overselling a little bit at this stage, so they always discount the numbers anyway. So if you don't give them some good numbers to begin with, then it gets discounted, you put yourself in a real problem. But it has to, you've got to be sensible. It's got to be realistic. If you put some numbers out there which I don't believe in, I won't invest. It's as simple as that. So you've got to be believable. It's got to make sense, albeit maybe it's the upside case that we're looking at as opposed to a more normalized case. If that makes sense.
How obviously we've talked about the numbers and the business, but how important is the profile and the personality of the founder as well in terms of deciding who to invest in?
Probably stole my thunder there. That's probably the point I was going to end on, because I think
sorry.
yeah, no, it's fine. The person or the people are really, really important. You've got to be able to see the potential for that person to be able to run a reasonably sized, successful business. For me, it's important that I like them and I get on with them, because if I want to be actively involved in helping a business, I want to do it. I don't want to feel like I have to do it because I put some money in, and not want to speak to the people involved at any point in time. So you've got to want to work with people. You've got to like them, and I think you've got to buy into their knowledge and their enthusiasm and their ambition. And if you don't buy into those things, then it makes sense not to make the investment. That's fine. You don't always gel with everybody. I'm sure there'll be some very successful people that I wouldn't invest in simply because at any point in time I didn't buy into them for one particular reason. We will all make mistakes, but ultimately being able to work with people and being able to see the potential in people is hugely important in any investment.
I think it's always it's that potential, both in terms of revenue and like just general scale, and seeing where this can go. That I think when we look at startups, is what we look for. That there's a founder we think is capable of doing this. It's the classic why you, why now from a pitch deck kind of thing, and the market's going to be there in the future. And I guess, what is it that you look for, Chris, in terms of, especially towards the back end? Because I've seen more and more decks where people are starting to put, exiting in 3 to 5 years, or, exiting 7 to 10 years. Is that the sort of thing you look at as well in terms of where they want to step out of this, or is that not, doesn't come into your thinking?
It's not a major factor to me, to be honest. I think you look for an investment that's going to be successful, and you know that it's going to take a number of years for that to be successful. If a founder is thinking of, say, 3 to 5 year horizon, it's not necessarily a problem, as long as you can see there could be a plan either for them to be replaced, or more likely for that business to be sold, and the acquirers putting the people in place. Having said that, you obviously want people to be fully committed to what they're doing. So you need to believe that they are going to do whatever it takes, work really hard, be resilient, etc., during the period in which they are there. But I'm more relaxed on exit profiles because I'm not working with exit funders, etc. So I've not got to return a profit to any external people. So hence it just works on my timeline. As long as it's successful in the long run, which is the main thing for me.
I think one of the things you mentioned as well there is about sort of your role, because whether it's that 3 to 5 years or 7 to 10, I think we've seen a lot is the role of what you do, not because you want to be more than just providing funds. And you see a lot of times you can get investors who are just, here's the cash, they sit on the board, and they just turn up to the monthly board meetings and just want that sort of feedback. What's the most common type of support you've seen founders really need from their early stage investors?
I think it really depends on the founder themselves. I think some people are more happy to be able to run the business their way and almost just report in. So you kind of use the opportunity to touch base with them and give some advice, but you're not that actively involved with those. With others, they generally want the challenge and a second opinion on the things that they're doing. And I'm relatively happy to do both, as long as I feel I am adding something to it. I don't want to be just the money, because it doesn't fit with what I want to do. There's absolutely nothing wrong with people that do that, but it's just not what I want to do. So particularly in the early stages, it's providing the sounding board and the challenge to what can be quite a lonely thing to do, to start your own business and have nobody else to talk to. So if I can do that and make sure that they do make sense in how they're thinking about things, I guess it can be helpful. I also feel that I'd like to stick with the businesses throughout their journey and help them scale up and help them become substantial businesses, because I think I've had the experience in the past in my career of doing that. The business that I ended up running, I was there for 25 years, and it went from essentially a startup all the way through the growth. And by the time I left, there's 1,100 people there, so it's a pretty big business. It's a pretty mature business. So I've seen most stages of growth, and therefore I think I can hopefully at least have an opinion, which may be helpful. Hopefully.
No, it is. One of the things I was going to ask you, Chris, I think getting those first tranche of sales in, that early traction for founders, seems to be the hardest, doesn't it? Because once you've got a little bit of traction, you can use that to build on and get more and more. And I think it's the bit that founders, we see, James, as well, they struggle to get off the mark early on. And I just wonder kind of what your advice is to those founders that seem to have tested product market fit, they've got a great product, they've done their MVP, but they've now got to get out and actually sell it, which is probably out of a lot of founders' comfort zones. What's your experience or any
I think
advice
that's the
you have
real
in
issue.
relation to that?
I think a lot of founders fall into the trap of thinking producing a good product or service is going to be enough to sell it.
Yeah.
It's not. There's going to be lots and lots of good ideas, good products, good businesses that fail because they don't find that route to market. And selling products is hard, particularly if you've never sold that particular product before, because there's lots and lots of different ways to make sales, and they don't work in all circumstances. I think it's really important for startup businesses to preserve as much cash as possible, to be very tight on their cash control, so that they can build a bit of contingency around their sales and marketing activity to allow them to experiment. And then once they find something that is starting to work for them, work that, iterate that, make it more efficient, rather than looking at lots of other things which may work as well. If you find something that's starting to work, follow your nose and make that better, rather than trying to find something which works a little bit better and a little bit better. You've got to focus on the few to make it successful, because it is hard. It is hard, and that's why a lot of businesses struggle to get that initial traction. And it's really important as well, because one of the things I was going to mention is raising money is quite difficult for founders. To get that seed money to put in there is quite hard. I think it becomes even harder once you've been around for a while and you've not got traction for other people to then invest, because there's an element of doubt about the ability to market. Whereas in the early stages, it's more a leap of faith, and you just have to believe it can be done as an investor. So I don't think any founder should underestimate the importance of that early traction, both in terms of getting revenue in, but also to be attractive to other investment, if that's what's going to be required for the scale-up journey.
100%, and I think the idea of traction as well. Obviously, when we're looking at MVPs, the sort of traction we're looking at is potentially user research, and, potentially testimonials at that level, just to see what, because some people can't generate sales before they've got their MVP, but we have seen more and more recently on Nairi, the people who've got some financial traction, whether it's selling, what before it exists, and that really helps people to make decisions. Like you said, Chris, have the confidence.
Yeah,
this is an investment.
I think founders also need to buy into what an MVP is as well. Each word's very important in that. It is the minimum, but it is also the viable, and it needs to be a product. Once you have that, then don't worry that it's not perfect. Don't worry that it doesn't do this, that, and everything else. Try and sell it, and then you'll also get the feedback from that early sales process about what the next best thing to add to the product is. So you may well be wrong in that you think it needs this, this, and this. It might need that, that, and that, and you'll get that feedback from your customers, who are the best people to give you feedback.
Yeah, but they have to be using it, don't they? And that's absolutely something. And it's something that came up at the UK Business Angels conference actually last week around like what does traction look like. If you can't sell it, then it can be letters of intent or something, but it needs to be something that's demonstrable. And just finally, Chris, you have given sort of loads of advice in these sort of 20 minutes for founders, which is really useful. But as somebody, I imagine you get quite a few pitch decks or pitched a lot, and if you don't, you definitely will after this one. What's the kind of one bit of advice you feel yourself consistently saying to founders, or the thing that you'd really want to hammer home?
I think that probably, as an investor, you want to see someone that's really enthusiastic about what they're doing. They need to really believe that they are going to be very successful, and they also need to be confident as well. I think don't be scared about talking about your product, because you're going to be the expert compared to the investors. The investors will ask questions. Sometimes they'll be daft questions, sometimes they'll be difficult questions, but ultimately that's not what they're going to judge you on. They're going to judge you on the products, the enthusiasm, whether they believe in you to deliver what they got, and they'll sort of be looking for that enthusiasm, and also resilience and important things like people just wanting to work hard, etc. They're going to put everything they need to make it their business a success.
I think that's the thing that's the most important to look for. Is, we always look for the story. Like I say, is it usually looking at the problem? Is it something they've experienced and understand? Is it part of an industry they've worked in, so they know what's happening and they just need that? In our case, more so, that technical help to turn that problem into the solution they understand. And like you say, Chris, focus on all three aspects of what's the smallest thing we can actually make some work, but still productize, still make sure it's something that people are willing to pay for. And if you can believe that story, believe the person, and back that up with the why is now the right time to do this, makes it harder and harder to actually think this isn't something that's going to work.
Yeah, 100%. And keep some money back for that sales and marketing as well, because you're going to need it. So make sure you.
Well, I'm pretty sure you were on a call where you say something about no disrespect to the marketing, but it's just there to look good or something. So I'm glad to see you've redeemed yourself.
I wasn't saying it was unimportant. Well, what we were talking
not
about.
That I've stolen that and bearing a grudge or anything.
What the message I was trying to get across though is that the personal touch is really important as well in some circumstances. In some products, in other products which I'm involved in, it doesn't need any personal touch whatsoever. And, so that's why the sales and marketing route has got to be appropriate for your service. There isn't one route which
so at this stage it's always about the founder, isn't it? Which is what which is something we've been pushing when we've been speaking to founders. It has to be founder led at early stage, and the marketing is there to support that. So I'll let you off.
Totally agree.
So Chris, I know we really appreciate you coming on. If so people have got an idea or they've got a startup and they're looking at investment and would like to reach out, what sort of information would you want them to have before actually reaching out to you? And then if they have got that, what's the best way to get hold of you?
I think the usual way is through LinkedIn. That's the one that seems to work most for most people. They reach out to me on LinkedIn. You'd expect there to be some form of deck so you can get an understand what it looks like. It doesn't have to be particularly refined, etc. But it's got to give an idea of what's going on and enough to make an investor to say, yeah, I want to find out a little bit more about this, and also be prepared to get lots of no's, because there's lots of things that I won't invest in. It doesn't mean it's not a great idea. It just means it's not for me. So don't be too disheartened if you get a no. I was thinking about this when I was just thinking about the podcast. I wouldn't have invested in Tesla and the first Tesla that came out, because I wouldn't understand the potential of the car market well enough to think that I can be of an assistance. Clearly, that would have been a really bad decision, but I'd probably still make that decision again with the next Tesla. Yeah. That makes sense.
Yeah, and we see loads of stuff, James, don't we, where it comes to us and one set of angels say no, and the next minute another set of angels have said yes. It is about right fit for that investor and that startup. So totally get that.
No, it's a lot about doing your research on whatever stage of investment you're at, who you're speaking to, what type of things that they like to invest in as well. So So what we'll do, Chris, we'll put, if you don't mind, a link to your LinkedIn.
Yeah, no problem.
Just so if you want to get in touch, they can do. And really appreciate your time.
Yeah, thank you, Chris. That was really useful for everybody.
It was great. Good to speak to you both.
Thanks much. Thanks.
you.
And thank you, Nairi.
Okay, see you, James.
Thanks, and for everyone listening, thank you very much, and we'll catch you on the next one.
I think that just about wraps things up here. If you have any thoughts or questions on anything we said today, get in touch, whether that be through our Twitter @RealTSF or email at hello@Thestartupfactory.tech, or feel free to drop in for a coffee and a chat. As ever, thanks for listening.